Smaller carbon footprints, more inclusive hiring practices, corporate transparency, all these ESG goals are certainly things to get excited about, right? Well, maybe not so fast. Rising scrutiny over so-called greenwashing and ESG reporting discrepancies pose headwinds to environmental, social, and governance efforts. And a struggling stock market hasn't really helped this year. But even with those challenges, more investors are aligning their portfolios with their principles. Researchers say ESG investing will more than double in the next 3 years. And more than 2/3 of Americans say they believe it's important to invest in companies that square with their personal values. But finding the best ESG companies can require some effort. That's why Investors Business Daily has put together its 4th annual Best ESG Companies special report. Public companies that made our Best ESG Companies list combine high Dow Jones scores with superior IBD technical and fundamental stock ratings. Topping this year's list is Worthington Industries. J.B. Hunt Transportation Services took 2nd place, while Verisk Analytics rounded out the top 3. Tech giants Texas Instruments and Apple finished 4th and 5th, while energy company First Solar came in 6th. Businesses participating in green energy transitions were also well represented on IBD's Best ESG Companies list. That's because environmental concerns have heated up for investors.
And those who fail to quickly recognize the shifting appetite for corporate action on climate, they're going to be at risk of investors potentially divesting assets and as well as the rising costs of capital.
Investors also worry how physical risks to company facilities due to extreme weather events will impact their investments.
Capital providers are increasingly recognizing that a company's financial performance, risk profile, and longevity are closely tied to the proper management of sustainability-related issues.
Because of increased regulatory and investor pressure around climate, a lot of companies have adopted ambitious targets to reduce emissions. More than 5,000 businesses voluntarily pledged to meet net zero carbon targets at the UN Climate Summit in Glasgow last November. That means roughly 1/3 of the world's largest publicly traded companies have now committed to emissions targets.
And namely, oil and gas companies and power generators are at a pivotal point when it comes to transitioning toward greener forms of energy.
But ESG has not been without controversy. Detractors of sustainable investing say shareholder activists are pushing politics over profits. Those sentiments underpin an emerging anti-ESG movement. Even Tesla CEO Elon Musk weighed in, calling ESG a scam after Tesla got booted from the S&P 500 ESG index over concerns about worker conditions and the company's carbon impact. That move had a lot of people asking, how could the world's most popular EV maker not qualify as a top ESG company? The incident reflects the ongoing debate about what exactly constitutes ESG investing. The lack of uniformity and application of sustainability metrics casts doubt over ESG. Is it a force for change, or are companies greenwashing their activities to look more environmentally friendly than they really are? Regulators at the SEC have decided to weigh in and have outlined several proposals that would put in place more disclosure and transparency requirements on ESG efforts by companies and fund managers.
This is very significant for ESG reporting and investing because in order to disclose such information, companies will have to collect and report high-quality data.
Despite these headwinds, ESG investing is here to stay. And as regulators bring more clarity to ESG products, investors will begin to exert more control over their portfolios.
Once we find a way to provide more standardization to data, investors will find easier ways to use this data in order to make better informed decisions.